it red book or yellow book?
So remember, we always go by the yellow book, right? So this morning we are going to go over government involvement in real estate financing. We're going to discuss the primary and secondary mortgage marketplaces, the roles of the parties in each one of these marketplaces, and the impact that they have through government influence. We're also going to describe the difference between conventional government and private loan programs available for real estate financing. We're going to discuss the different alternative and special loan programs that are available for borrowers who need special needs, and the role in the government as far as regulations go, and real estate lending and consumer protection, and making sure that we understand what unfair lending practices are all about. So we're going to talk about blanket loans and buy downs and Ginnie Mae, Fannie Mae, Freddie Mac, FHA, package loans, private mortgage insurance, and so forth. So when we think about the financing market, what are the three basic components of the financing market? Who knows?
Primary mortgage market.
Right. Secondary mortgage market, and what's the third one?
Secondary mortgage and the Federal Reserve.
That's right, or the government influences like the Federal Reserve, right? So what is the Federal Reserve System? Who knows? What is the Federal Reserve System?
It consists of 12 Federal Reserve districts and banks.
Right, so 12 different Federal Reserve districts. What does the Federal Reserve do?
Regulates flow of money and interest rate.
Yes, helps counteract inflation and deflationary trends, right? Helps to keep a favorable economic climate. At least that's what they say they do, right? Which, you know, there's a lot involved with that. Even discussing things such as the interest rates and what is the rate that banks charge each other, banks that are part of the Federal Reserve, right? So we know that there's 12 federal districts, each has a Federal Reserve bank, right? And there is such a thing called the discount rate. So again, what is the discount rate? Anybody know? Who knows? What is the discount rate?
Is that the minimum rate that they charge the Federal Reserve?
Each other. So think about it this way. You have a small kind of local bank. You know, I don't want to name names. I'm not sure exactly who it might be, but, you know, maybe the town of ABC decides to, you know, town of ABC Bank. And maybe it was a few business people that got together and made this regional or small state bank, whatever it might have been, right? And then we have a huge global conglomerate. Well, do you think if this small state bank needs to borrow money, they would go to these larger banks? And do you think that that larger bank is going to just give them the money for free? No, right? They are going to want to charge a discount rate, or a rate in which, you know, an interest rate in which that the Federal Reserve members will charge each other, right? They also might have reserve requirements, which means, well, how much money when they take in deposits and so forth, how much money, what's the minimum level of funds that that institution has to maintain? So that will be important for them to do. They also, meaning the Fed, influences the prime rate. So who knows what's the prime rate or the base rate? That has to do with who?
The government.
Well, it has to do with basically you and me, right? It has to do with consumers. So the prime rate or the base rate is what many banks will charge, plus sometimes a premium, of course, for loans or small business loans, credit card loans, different types of financing. Okay, So we kind of just went over a lot in this last couple of minutes. We talked about the three basic components, meaning government influences like the Federal Reserve. And we said there's 12 federal districts. We talked about the primary mortgage market, that's part of it, and the secondary mortgage market. So those are the three components. Then when it comes to the Federal Reserve, we just said, hey, we need to know what the discount rate is, which is what bank members charge for interest to each other. And then we need to know what the prime rate is, which is the interest rate that banks will charge to consumers, plus a premium usually. You know, like for instance, you might be able to get a loan and they tell you, oh, it's going to be prime +1, right? So now you know what they're going to be charging you. Because you can actually go on the Google or whatever it might be, the internet, and look up the prime rate all the time. And so you'll know your interest rate, if it's prime +1, prime +2, depending on what kind of loan or financing that you're getting. Okay. So the second component of real estate financing market is the primary mortgage market. So who is the primary mortgage market? These are lenders
who originate the loans.
Right? So these are lenders that originate the loans. And these hopefully are usually, not all of them, because we're going to talk about different parties as well, but these are some parties that you know about, right? It could be the Bank of America, People's Bank, Webster Bank, right? And we'll talk about other parties or that include this as well. But these are the parties that make money available for borrowers, right? They look at the loan that they're giving you as an investment, right? So from their point of view, it's an investment. And they can sell this investment, and they're looking for profitable returns on this investment. And they make money two ways. How do they make money?
Interest.
Yep.
And reselling the mortgage.
Not well. I guess you could say that. So they make income or cash flow on two ways, right? Two sources: financing charges that they collect at closing, right? Like loan origination fees, discount points, and then recurring income or the interest on the loan. They probably make money when they sell it as well. But when we talk about how do they make their income on a specific loan, we want to know those two things, because there could be questions on the state exam about those two particular items. So does everyone feel comfortable with that?
Mm-hmm.
So yes, they do make money when they sell their loans. They also might make money when they service the loans, right? There are some companies out there that they just deal with collecting the payments and answering the phone calls from customers, doing the accounting, doing the bookkeeping, taking care of all the records and tax records and processing the payments and making sure insurance is taken care of and following up on loan payment delinquencies and so forth. So there's a lot of different things that different parties will do in the primary mortgage market, right? So who has questions on that? Anyone? All right. So there's a lot of different lenders when it comes to this. There's, of course, banks, savings associations, commercial banks, and they're known as fiduciary lenders. Why? Because what their main goal or one of their fiduciary obligations is to make sure that they are protecting and preserving their depositors' funds. So you might have $285,000 just saved up in your savings account, right? Wouldn't that be awesome? You just have like, let me throw $250,000 in this savings account over here, right? And so if you were to do that, you're going to make sure that you're with someone that you can trust, right? And so their main goal is to make sure that that money's preserved and protected. Did someone have a question? Okay. So again, that's their fiduciary obligation. They're subject to all these standards and regulations by the OCC. Who knows what the OCC is?
Government agency that sets the standards and regulations.
And the name is the Office of the Comptroller of the Currency. How's that for you? Right? And so I always remember back in the olden days when we used to walk into a bank, right? And before you went up to the teller, you'd see like the square or the rectangular sign, and it'd say, and it was a lot of times for some reason I remember it being brown. And then in gold, it would say FDIC. And it would say that these deposits in insured institutions are covered up to $250,000 per depositor. And I'd be thinking, oh, wow, so I can only put $250,000 in here. I don't know if I want to do that. I'm only joking, but we got to have some fun, right? So anyways, remember though, that's and those are covered through the Federal Deposit Insurance Corporation, the FDIC. Now, there's other parties as well when it comes to the primary mortgage market. We have insurance companies. Well, what do insurance companies have to do with mortgages or loans? Who knows? So regardless of what you want to hear on the news and what you might hear for spin, insurance companies, they know how to make money. All right. And so they invest in loans. When they have profit, they need a place to put that money, right? And so they will invest will invest in certain profit earning enterprises. And a lot of times it'll even be like large commercial real estate loans, which of course sometimes they get burnt. Of course, sometimes those loans fail, but they do participate. Credit unions, everybody's heard of a credit union, hopefully, right? And so those are mainly cooperative organizations that they like to place money in loans or give loans to people, and again with depositors and so forth. And they are regulated by the National Credit Union, the Association, so the NCUA, right? And they insure up to $250,000 in all federal credit unions, as well as the majority of state chartered credit unions. So it might not seem like a big deal to you. You might never even be thinking about it when you put your money in a bank. But you want to make sure you go into a credible bank, and that, hey, if something was to happen to your money, you're going to be able to get to it, right? Pension funds. So in 2020, who knows what a pension is? Do we have those anymore?
Very rare.
Nah.
What's a pension?
What is a pension? If you're my age, what am I going to be? 51? Oh my on, right? I'm going to be 51. I might get a little pension from UPS, but after that, I think I'm pretty much on my own, right? So you have pensions are what? They're usually money that a company has put aside for you, okay? For your retirement. They've invested in you somehow. And so now they have this money. Do they just want it to be sitting in some bank vault? No, they want to invest it, right? They want to invest it so that they can have higher yields. They can make more money off of that money. And so again, they might be financing or being involved in different real estate projects. The wonderful world of endowment funds. They are another party to the primary mortgage market. So, you know, next week, I forget the day. I think it's August 29th. I'll be bringing my daughter up to Springfield College. No, 28th. And then I think August 29th, I'll be bringing my son, one of my sons, to University of Rhode Island. Very proud of them. And my other son, he's going to Central as well. He'll be starting, but he's staying local. But endowment funds, there's many colleges that they have endowment funds in hospitals and charitable foundations. And they, my friends, are sitting on a lot of money. Okay? I don't want to disparage anyone, but I don't think there's going to be anyone from Harvard listening to this video anytime soon. Maybe there will be. But just as an example, do yourself a favor, you'll be amazed. Go into Google or Yahoo or whatever you like to use as a search engine and put in Harvard University Endowment Fund. Yale Endowment Fund. Some of these colleges have billions of dollars just available, right? And so what do they do with it? Again, they want to make sure they're investing it. So they might invest for low risk commercial, industrial properties, different types of loans, so that they can make a return on their money. You can't blame them, right? But I do think it's pretty incredible on how there are a lot of colleges, universities, and even hospitals that they get a lot of tax advantages, they get a lot of tax breaks, and maybe they do help out the public, but they're sitting on billions of dollars, right? Investment group financing, right? So it might be some kind of large real estate project, a high-rise apartment building, office complex, shopping center. They might have different arrangements like a syndicate. Anybody knows, who knows what's a syndicate? That could be in the real estate state exam. Anybody have an idea?
A group of investors or a group that, you know, does something in concert with each other,
Right?
similar, expecting a similar outcome or the
Yeah,
same.
I mean, we don't know what's going to happen. Tanisha might send us all an email this afternoon and say, hey, I found this $1 million property that we can all make a lot of money on. And if y'all want to put in, $50,000 each, you know, we can do this, this, and this, and it's going to be awesome and huge, and let's make it happen. Right? And we can create a syndicate or a partnership or an investment trust or whatever it might be in order to, and some of those really, actually, I take a step back. So anyways, Tanisha can help us form that group and we can buy a nice big property together. Or you can actually look up real estate investment trusts, REIT, right? And those I love to invest in. I think it helps for you to diversify your investments. And so some of these REITs, they go out there, they have a certain sector that they're looking for. Like they might be into saying, okay, we are as a group, we're just going to buy residential properties in the South Atlantic, meaning like, you know, North Carolina, South Carolina, Georgia, and so forth. And that's what they invest in. And then you can decide if it's a good investment for you as an individual investor and maybe figure it out from there. But anyways, that's the whole thing about investment group financing. Mortgage banking companies. So of course, there's a lot of different mortgage banking companies that they originate loans and with money that's belonging to the insurance companies, pension funds, individuals. Sometimes they do in-house financing, right? And so that's an interesting concept because you see, you have to think about it this way, and especially because we're getting ready to talk about the secondary mortgage market, is that do you think that if a bank or a lender gives you a loan for 30 years, that they are just kind of sitting there waiting over 30 years to get the money back from you?
Mm-mm.
No, right? Probably over, I don't know the exact number, but I would probably say over 75%, they do what with those loans?
Invested again somewhere.
They usually sell them, and they sell them on a secondary mortgage market. And so that's why every now and then, and that's why we talk about credit scores and everything. So every now and then, you do have some lenders who are willing to be more flexible with things, such as your credit score or your work history or how much money you put down. They're willing to be more flexible with those things because maybe they're going to plan on funding it themselves and actually keeping the loan for 30 years. Every now and then. Are they hard to find? Yes. Does it happen often? No. But every now and then, if you're in a particular pickle, you can find yourself, that you need to find a mortgage, you can find yourself one that will work out. And then we have mortgage brokers. So just like real estate brokers, mortgage brokers, they're not the actual lenders, or real estate brokers are usually not the actual sellers, right? The brokers are the people that bring other people together, just like in real estate agents, real estate brokers, real estate salespeople. We bring people together in order to help them and process types of things. So mortgage brokers are going to do what? process loan applications, submit the applications for final approval. They usually don't service the loans, you know, so think about it this way. You buy a house and maybe 7 months later, God forbid, you can't pay the mortgage. Are you going to call up your loan originator, your loan officer, and say, hey, Joe, you know, just want to let you know I'm not can't make the mortgage payment this month? What's Joe going to say? He'd be like, dude, you got the wrong person. You don't call me for that. You need to call this company. You need to go look at your mortgage statement and call that 1-800 number and wait like 25 minutes on the phone, right? So those are not the people that usually service the loans and so forth. All right. So who has questions on those types of things? Do you need a license to do mortgages?
Yeah,
No,
don't you need? I thought you need some sort of training.
So here's a
we
story.
don't
Back
have
in,
that.
back in the olden days, I actually originated and did a lot of mortgages for people. A mortgage being also, you know, I had the one-stop shop, right? You would come to me, and I helped out a lot of people, believe me. And the majority of these people I still talk to, stay in touch. You know, that's my database. I have great relationships. So I was able to do the mortgage, I was able to do the real estate, and then I was even able to do the insurance, which was pretty awesome, right? But then after the mortgage crisis and all this kind of good stuff happened, the federal government put in place this system of licensure, right? For basically saying that all mortgage loan officers have to register annually and meet other requirements like continuing ed and so forth for similar to real estate agents, right? It's not like they have to go to a class like this specifically, but there is some registration and there is different things that you probably need to do in order to maintain, you know, being a loan officer. And so it kind of got to be too much because you just really can't do everything. It sounds great. It was awesome. But even in today's world, if I wanted to maintain that, I could, but in most government loans, like what would be an example, who knows of a government related loan? Government related loan, I shouldn't say government loan.
Not FHA.
Right, FHA, VA, USDA, CHAFA and so forth. Most of these types of loans, you cannot be the real estate agent and the mortgage loan officer because they feel, even though I feel I've helped out a lot of people that way because I was able to save them time, money, energy, be the one stop, one person contact. The government, I believe, feels like it's a conflict of interest in many cases. So you can't do both together on the same loan. And so that made it even a little bit more harder. And I was like, forget it. I'm not going to do it. I'm not going to do both. I'm just going to focus on real estate. All right. But, you know, there is a licensure type of system. So that's pretty much the primary mortgage market. Who has questions on that? Anything that you want to go over, talk a little bit more about that? All right. So the secondary mortgage market. Who has an idea? What is the secondary mortgage market?
They're the ones with that are the resellers or receive the resold mortgages from the primary.
Right. And so it's basically, you know, the place in which lenders raise capital, right? They sell their loans. Loans are being bought and sold. They're able to free up capital, stimulating the housing construction market and the mortgage market. They're able to avoid maybe some interest rate risks by making a profit, by making profits on the sales and not sitting there and waiting 30 years and so forth. So basically they're able to sell it on the global marketplace, right? And so these are usually assembled into blocks of loans called what? Anyone know? Pools, right? So again, that's one of those italicized words that you need to know in your yellow book, right? So they're assembled into pools. And so these different enterprises, I guess we would call them, or key players in the marketplace, they're also referred to as government sponsored enterprises. So depending on the time of the cycle of the government, sometimes they're like big time controlled by the government and the government wants to take them over. And then in other times of history, they were kind of like put aside that they can do their own thing. But there's 3 institutions. One's called Fannie Mae, which handles conventional, FHA insured. Now you see, that's a key word, insured. FHA are insured loans. And then VA are guaranteed loans. So as we go further into different units, you're going to want to understand the difference between insured, FHA insured, and VA guaranteed loans. Then we have Freddie Mac, which is mostly conventional loans. And we have Ginnie Mae, which is special assistance loans. Make sense? All right. So Fannie Mae first. Basically, what do? They buy from the lender a block or pool of mortgages and then use them as collateral for mortgage-backed securities that are sold on the global market. Okay, so that's a whole lot to take in at this particular moment, right? But you just have to remember what they're doing is they're going to larger banks who have pools of mortgages and selling them. Now, that is the reason why we might have someone who calls me up and says, hey, what's the minimum credit score that I can have to buy a house? So who knows? Is there a minimum credit score to buy a house?
No.
No.
No, technically not. But let's just say the 90% of residential mortgages or loans, they're going to be basically by either conventional or mortgage or FHA requirements. And so, you know, at one time we were telling people it was 620, but if your credit score was a 581, could you get a mortgage? Yes, if you find that right lender who's willing to do it, who might not be able to necessarily sell it in this one particular pool, right? Because it's riskier. So maybe it has to go into a different pool of loans of all these risky loans where they probably make less money on. Okay, because the higher the risk is for everybody. The lower your credit score, they're going to look at you as a higher risk. And you might be like, oh my God, that's not fair. Why are they doing that? Well, they say that your credit score is a reflection of your past abilities or desires of paying your bills. I don't know. You can fight that. You can debate on that statement. But I never seen somebody that never missed a payment, right? You can't say, oh, I never missed a payment on anything and I'm awesome with my money and all this good stuff and I have a credit score of 522. You just can't say that. You could say things happened in your life that made it hard, you know, God, and we have to have compassion and empathy, and we have to say, I'm so sorry to hear that somebody had passed away, or that you lost your job, or that, you know, you decided to get a car loan for $427 a month and you couldn't pay it. I'm really sorry to hear that, you know, but these things happen, right? And so I understand. I've been down the road myself, right? I've been down the road, made some silly choices and so forth, and then had to clean it up. So with that in mind, we do the credit repair. We help people get to that point so that they can maybe get a loan with better terms and conditions. And so that's why we talk about Fannie Mae with these mortgage-backed securities. They usually take in these pools of these FHA or conventional loans and VA loans and are able to sell them, right? Freddie Mac is mostly conventional. So when I say the word conventional, before I don't want to make assumptions, what do I mean by that? What does that mean, conventional? I appreciate all of you giving me opportunity to take a few sips of my coffee. So what do I mean by conventional?
Standard.
I call it a regular loan.
To me, it would be nice. Maybe it's just me, and I like to help out people who have had it rough. So to me, it would be nice if it was regular. To me, it's like the exception. Because conventional, now back in the olden days, it used to mean that you were putting 20% down and that you had good credit, good job history, good credentials. So do I get people that buy homes conventional loan? Yes. But to me, I get more people FHA because I'm helping out so many people that they don't have the 20% down. Maybe they only have 3.5% down. Maybe they have some exceptions on their job, like, you know, that they were out of work for a little bit, or they switched industries, or they need to, maybe their debt to income ratio is not the best, and so forth. So conventional, just think about it now. There are so many different lenders and programs out there where they can say, well, you know, we have this program. It's a conventional loan where you put down 5%, and then you can do this, and we give you the money for a grant for this 3%, and ba 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 ba. Right? So we don't say it's just 20% anymore, because there's all these different conventional loan programs. But as an example, yesterday, I had to do a lot of damage control that, once again, was not my fault. Just to give you a real life example. My seller had 3 or 4 bad experiences with someone who was going to get, or a couple different people who were going to get these different types of loans. And so she says, listen, I'm not dealing with all these different loan programs. I just want to sell this darn house. And anybody who comes with an offer, they need to go conventional or cash, and that's it. And that's the seller's choice, okay? They want somebody who's gonna who has good credentials in their particular scenario. So what did we had 4 or 5 offers. We've been down the road with this house. This one woman came along, oh, I can buy the house, no problem. I got this, I got that, the other thing. And they gave us a pre-qual letter for conventional loan. Here we are 3-4 weeks into it. What did I get the phone call yesterday? Oh, we're sorry. We can't go conventional anymore. We can only do FHA. Will your seller still accept the loan? Can we still please move forward? We love the house. We really want it. Blah, 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 blah. And so now it was like, well, why can't you go conventional anymore? I thought you could go conventional before. Oh, we just had some issues, and you know, we just can't do it. Well, why can't you do it? Well, after like prodding for like 6 minutes, because if you want to be a good realtor, now who am I working for at that moment? I'm working for my seller. The buyer, she didn't come to me. She has another agent. So I'm talking to the buyer's agent. I'll call her D. D, I need to know the truth. I want to know why she can't get conventional any longer, because the seller's going to feel like she was pretty much lied to, like she was bamboozled, and she trusted in me to give her advice to accept your offer because you and the loan officer said all these great things and there was going to be no problem and blah, 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 and we're supposed to have a closing in 10 days from now, and now we find out we can't, and that the buyer can no longer go conventional. So what did the truth come out? Is her credit score went down. And why did her credit score go down? Because she charged more on her credit card, right? So then I had to make a phone call to the seller and give her the long story. And you know, it gets a little trickier because the buyer, even though the buyer's agent is not with my office, she's a different office. She's, you know, 15 miles away in a different real estate office. It's the same company name. So my seller's like, oh, well, you guys are the same company. How did you know this? I mean, why didn't you know this sooner? And is this for real? And, you know, your company's getting the full commission. And I had to do and that took another 30 minutes to give the full explanation, to make her feel more comfortable, and to put a plan together to go further and what we were going to do. And so she ultimately said she would move forward with an FHA loan, but that if any issues came up, it would be up to the buyer to take care of, and she didn't want to deal with it. Otherwise, she says, I'm just going to take the house off the market and we'll wait till next spring, Rob. All right. So you see, people take those whole things about conventional, FHA insured, VA guaranteed, everything pretty seriously. So who's got questions on that before we move further? Because we just talked about Fannie Mae, Freddie Mac. We talked about FHA insured loans. We talked about conventional loans. Who has questions about those? Okay, who has any idea what is Farmer Mac? Anybody know what's Farmer Mac?
Farmer Mac,
Uh,
not Ginnie Mae, not Ginnie Mae.
Nope, Farmer Mac is its own thing. What is it?
Is
For
it for
farms.
agriculture?
That's right.
Farmers
Pretty simple,
are-
right? Privately owned, publicly traded, established by Congress in 1988. I don't know. To me, it seems like 1988 was yesterday, but I guess that was a long time ago. To create a secondary market for agricultural, mortgage, and rural utility loans, and so forth. We also have Ginnie Mae, established in 1968. Now, the thing about Ginnie Mae that's different from the other ones is you have to remember this term. Even though you might not understand it 1000%, you have to maybe even do a little bit more research on it, but it's called, Ginnie Mae will do what's called, they do special assistance programs and so forth, and they have what's called a pass-through certificate. And basically that's a security interest in a pool of mortgages. So remember, that's almost like a stock in a way, some type of a security interest in a pool of mortgages, but it provides for a monthly pass-through of principal and interest payments directly to the certificate holder. So in the other institutions, you would get some type of certificate rate, and you probably make most of your money, you know, at the price that you buy it at and the price that you sell it at. Well, with Ginnie Mae, you're buying a certificate if you're one of these investors, and the principal and interest payments are going directly to you. And those are certificates that are guaranteed by Ginnie Mae. And you're talking about, you know, millions of dollars. These are huge pools. You know, I met somebody, you know, quite a few years ago that they worked in this field. And just to hear some of the stories and the numbers of stuff that they do, it's pretty wild. So anybody have questions about the three about Fannie Mae, Freddie Mac, Ginnie Mae, Farmer Mac? All right, so let's talk about different loans. So we already talked a little bit about conventional loans. Usually in the past, it was making a down payment of at least 20%, but we remember now that there's other ones that you don't have to. Usually you make that payment of 20% down payment so that you don't have to pay PMI. And PMI is what? Private mortgage insurance. And you are paying, as the consumer, you're paying for this PMI, right? In case you default where you can't make a mortgage payment. Now, does that protect you so that you can still keep the house?
That's your loan.
No,
No.
no.
Mm-mm.
It's the
What are you
lender.
buying the private mortgage insurance for?
The loan.
The lender, right? So they're saying, hey, listen, if you want me to give you this money, right, you're gonna have to, and you're putting down less than 20%, you're gonna have to pay for mortgage insurance, private mortgage insurance, and that's private mortgage insurance for me, that if you default on the loan, I'm still gonna get some of my money back, right? So, you know, you see, if you don't have the credit score, if you don't have the decent down payment, the decent work history, you end up paying more for these mortgages. Yeah, that's the truth of the matter, because you're considered to be a higher risk, right? And so they have different limits. Like for instance, they said, okay, the maximum loan limit in 2018 was increased to 679,000 in high cost areas. And each county is different. And they, in your book, they do give you the website, which you don't have to memorize that, but they do give you the website to say, hey, listen, if you want to look up what Hartford County is and so forth. And I think, you know, Hartford County, I'm just going to guesstimate that it's somewhere around 500-something-thousand. I forget. I never remember those because it's not really the exact part of my job, right? That's the mortgage person to know that. But anyways, and then if they have to go higher than that amount, then that would be called a non-conforming loan or a jumbo loan, right? And so those are different kind of loans that we can have as well. So we talked about private mortgage insurance and what that does. And usually the borrower has to pay what? A monthly premium while it's in force, while the loan is there. And so it used to be that, well, we'll talk more about that in FHA loans. But basically, when it comes to conventional, if the lender, if there's over 22% equity in the home, you can usually get rid of that PMI. Okay, for conventional. Now for FHA, in most cases these days, you have to actually refinance to get rid of the PMI, or actually the mortgage, the MIP, the mortgage insurance premium. Okay, any questions on that? So FHA refers, basically FHA loan means that it's insured by who? The Federal Housing Administration. It doesn't mean the government's giving you the loan. It doesn't mean that FHA is giving you the money. It just means that they are willing that if you go to Chase Bank and you give them a mortgage, you get the money, right? And you're giving Chase Bank the promise that you're going to repay them, and it's less than 20% down, and you're getting a FHA loan. It means that FHA is going to insure that money, because what are they going to do? They're going to say you have to have all this certain criteria. You have to have this particular credit score. You have to have this particular work history. You have to be able to show your last 2 bank statements. You have to be able to show your last 2 or 3 months income statements. You have to have a good debt to income ratio, right? And so all these boxes have to be checked off in order for you to qualify. Once in a while, they'll give you a little bit of an exception if you have an explanation as to why, but that's why all the underwriters in each lender's office, right, that they are double checking the loans and checking off each box and seeing what conditions, what information they need in order for it to pass an FHA loan. So that way, when that lender goes to sell it, they're going to be able to sell it without a problem. Make sense? Any questions on that? So there's all different types of FHA loans, adjustable rate mortgages, home improvement, rehab loans. Usually you can go with a 3.5% down. We even have different programs where it's no money down. You could get a second mortgage, no interest for a certain amount of time for the 3.5%. There's so many different programs out there. The thing that you have to remember as a consumer is don't push the envelope too much, because you don't want to find yourself in an issue where you're getting kicked out of the house you live. The second thing is, when you're working as a real estate agent, is make sure your clients understand, you know, the basics of what they're signing up for. Because I have some clients, they get approved for a house $280,000. And so now they want to look at those homes that are $280,000, God bless them. And then they find out that the payment's going to be, you know, $1,800 a month, and they don't want to do that. And they want to do $1,200 a month. And that's fine. That's great to me, right? Because I know what I'm doing, and I talk to them before I even show them a house. But there's a lot of buyers that I end up meeting that say, oh yeah, I looked at 3 other houses with this other agent. We go to make an offer and they told me it's going to be almost $1,900 a month. How come she didn't tell me that sooner? And between the mortgage person, because remember, it's a team effort, between the mortgage person and the real estate agent, before you even go show houses, you should kind of be talking with somebody like, hey, listen, so a house in this price range with these taxes and so forth is going to cost you about $1,350, $1,400 a month. Do you feel comfortable with that? If they say yes, make it happen. But if they don't, and they might be like, no, I want to be closer to $1,200 a month, or I don't mind, I can go up to $1,800 a month. Then you know what you're doing. That's part of being a real estate agent. You don't have to be the expert on all the numbers and the calculations, but you do have to be aware of how you can help your client and don't waste their time, right? And so that's really important when it comes to FHA loans, is understanding the down payment, understanding that there's going to be a mortgage insurance premium, right? That's going to be charged up front at the closing. That's part of their closing cost. And then their monthly payment, boom, 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 because they're putting down less than 20%. And then talk to your mortgage person that you're working with. But most likely, in order for that buyer to get rid of that $150, $200 a month mortgage insurance payment, they're probably going to have to refinance when it comes to FHA loans or government-related loans. Make sense to everyone? Okay. The lender of these FHA loans might also charge discount points. Who knows what's a discount point?
When you pay interest up front to get your payment down, your monthly payment down, essentially, to bring
Right.
down your interest.
Exactly. So it could be part of their loan origination fee. It could be that the seller's willing to pay a discount point to help them lower their interest rate. So there's a lot of different ways in which they can look at it. Can FHA mortgages or loans be assumed by other people? Yes. However, there's a lot of rules on it. So according to the book that I have, and yours might be a little bit different because you might even have a newer one, but as of like a couple years ago, they said as of December 15th, 1989, an assumption is not permitted without complete buyer qualification. So if your loan was after December 15th, 1989, which is, if you think about it, is what, 20, that's that's more than 30 years ago. Does anybody have their newest book, the 15th edition, open or no?
I do.
Do you see under assumption rules, FHA? What's the date? Should be
The
section.
red book, right?
What's that?
Go on the assumption rules, you said?
Under unit 13, right? Government involvement, FHA insured loans.
That's the red book you talk about then.
No, yellow.
Go back to the yellow?
I have it.
Okay.
A qualified buyer may
says-
assume an existing FHA insurance loan. The application consists of credit check. The assumption rules for FHA insured loans vary depending on the date the loan was originated. As of December 15th, it says 89 as well.
Yeah.
Oh, I have, no, but my book says 88. I
Yeah.
got the 20th edition.
Wow.
Oh, I have the 20th. Okay, sorry.
So the point is that I could tell you most of these loans, they say they'll do an assumption, but with the dates involved, it's really pretty hard, right? It's really pretty hard. It's not easy necessarily to do an assumption. We know that there's HUD home sales out there. So remember, we have the Housing Urban Development, and basically they will provide opportunities for home buyers and investors. They have such a thing as called the Good Neighbor Next Door program, which sounds really great because they might give you 50% off the list price of a property. But I can just tell you very straightforwardly, it will depend on where you want to live, because those are areas that they're trying to revitalize. So if you're a firefighter, law enforcement officer, emergency medical tech, a teacher in that town, they'll give you that loan up to 50% off the list price. At the same time, those areas are really, really pretty rough. I've helped out more than one person look at those homes who are thinking about it, and more than once we have heard gunshots in the area, or standing right in front of the house talking about whether they should make an offer, and you see one guy standing at the curb, a car pull up, they exchange money in some kind of baggie, and the guy takes off. Like I'm talking like 12 feet away from you. I mean, it's pretty incredible that could really happen. Or where, I had one guy, he was so gung-ho about buying this house. He actually bought it, but just really quickly, he had this beautiful, beautiful little family. He had this new wife that she was from Central America. She really didn't speak any English. And little daughter who's like 2 years old. And we're getting ready to walk in the house. And I said, are you sure this is going to be good for you? Is this something where, we can take a look around? Oh, no, it's fine. And I'm opening up the door, and I'm terrible at keys. Keys, I don't know, keys and door locks, I'm just not good at it. And I'm fumbling, trying to get it open. and we hear boom, 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 and some guy screaming, screaming, swearing, and then a bunch of running down the street. And I'm like, whoa. So I duck. I'm like, I like put my hand like, over there a little bit on them a little bit. I'm ducking. And I'm like, dude, do you want to get out of here? He's like, no, come on, let's go. We look. I'm like thinking to myself, man, we're only 2-3 houses away. We're hearing gunshots. And he didn't care. He still bought the house and everything was good. And I'm like, oh my gosh, but he wanted to get his 50%. So he got it, right? He got his 50% discount. But hey, that's what you want to do, you can do. We have VA guaranteed loans. So remember, FHA, what happens is FHA insures it for the lender by you paying the PMI. With VA, for our veterans, basically they guarantee the loans with the lenders, right? So that's a big difference. And it's not guaranteed for you as the consumer or for me. I mean, I'm not a veteran. I wish I was. I didn't have the opportunity to serve, right? My son, he's in Rhode Island right now, but he's jumping out of planes. He jumped out of Tuesday or Wednesday, he was jumping out of planes into the Newport Beach, jumping out of a helicopter, right? So he's in the Rhode Island National Guard, which is kind of cool. So anyways, the whole point though is with veterans, Veteran Affairs, they'll guarantee the loans for the lender, right? And they say that there's certain time and service criteria. So it has to be, for instance, they say at least 90 days of active service for people who are like in World War II, Korean War, Vietnam, Gulf War, or maybe minimum of 181 active service days during 1947 to 1980, or 2 full years of service during peacetime, or 6 or more years of continuous duty in the reserves or in the National Guards and so forth. Do you have to memorize all those? No, but you have to be somewhat familiar with how they come up with a service criteria, right? And just know that it is 100% financing if that's what the veteran wants to do. And what the VA will do is they limit the amount that they will guarantee. So usually what they will guarantee is 25% of a loan up to $453,100, right? So if they tell you, so what's going to happen is the VA is going to be able to give the veteran their eligibility, the amount or the VA dollar limit. So for instance, if they give the VA dollar limit, they tell them $50,000, right? So technically that's 25% of what that's guaranteed to the lender. So it's 25% what the lender will do. That's 25% of what the lender will do. So if their VA dollar limit for the veteran is $50,000, that's 25% of what the lender will allow them to borrow. So the lender would allow them to borrow $200,000. Does that make sense? So if their VA dollar limit was $60,000, how much would the lender let them borrow? $240,000. Make sense? Because the VA dollar limit is 25% of what the lender will let them borrow. Does everyone get that? Does anybody have any questions on that? Because I don't want to just like fly through it. Everyone feels comfortable? All right. So if a veteran was to buy a home, they put a purchase and sale agreement together. The next step is the VA is going to do a certificate of reasonable value that's based upon a VA approved appraisal. And they'll have a ceiling amount of what's the most that they will do. The VA borrower will have to pay a loan origination fee to the lender, right, as well as a funding fee. And so there is some savings. There is some savings that the veteran buyer gets. I mean, they can't be charged any commission fees or brokerage fees from a real estate agent. And the seller has to pay for their termite inspection report. There is no prepayment penalty. They can be, they can prepay the debt whenever they want to without a penalty. And there are some assumable rules, like for instance, VA guaranteed loans made on or after March 1988 are no longer assumable without prior consent from the lender, right? And the seller can pay for some closing costs up to 4% of the loan amount. So kind of the basics of a VA guaranteed loan. So remember, FHA is insured, VA is guaranteed. What kind of questions does anyone have on that? All right. Agricultural loan programs. Okay, so there's all different ones that maybe rural areas can look at. They have the Rural Housing and Community Development Service, the Farm Service Agency, the Farm Credit System, providing loans to farmers, ranchers, rural homeowners, and so forth. One of the things that's also really cool, and we even have that here in Connecticut, which I think is pretty awesome. I mean, we're talking about 10 miles from Hartford. You can get a USDA loan, U.S. Department of Agriculture, 100% financing, and the interest rates are awesome. So if you're looking to try to do something 100% financing, look into USDA loans. Even if you put in USDA loans in Connecticut and then look up images, it'll show you the maps of the towns where you can get a USDA loan. Now remember, most of these types of loans have to be owner occupied, but they're really, great opportunities. Okay, there's other financing techniques or ways of structuring financing. So the first one is a package loan. Anybody know what's a package loan?
And everything in the house goes with the house, basically.
Right. And so remember, that's pretty much what we're talking about. Real property and personal property. And when we say personal property, we might be talking about furniture, drapes, other appliances, and so forth. And usually these are the kind of loans or packages that you usually see when it's like a brand new development, maybe vacation homes types of things. We don't usually see this for like regular resale, seller to seller. These are like developers and condos and big investment properties. We also have a blanket loan. What's a blanket loan?
More than one lot?
Yes. So remember, you might be that person that you want to buy these 100 acres, and then you're going to subdivide them into 2 acres each. Boom, 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 boom. And then maybe you're going to build on them, maybe you're not. But you have to take out a loan, let's say, to buy these 100 acres. Well, every time you sell one lot, you don't want to have to redo the whole loan, right? You don't want to have to maybe keep paying on something that's, refinance the whole thing. It's kind of a lot of work and energy and money. So basically, there'll be provisions in place to do what's called a partial release clause. So every time you sell one lot, right, the lender is going to have a provision where it will be able to release those lots and change the loan balance and the loan payment and all that type of stuff. Make sense? What's an open-end loan? Okay. Basically, when somebody has some type of loan where it also allows for future advances. Maybe they tell you, well, right now for construction or whatever, well, we don't want to say construction loan, but right now we'll allow you to borrow up to 100,000. And then if you were able to do this or this or this, then we can go up to 120, we can go up to 140. And so, usually we don't see a lot of these out there, but sometimes if you have excellent credentials and a great relationship with a lender, they'll let you do an open-end loan, right? Where the initial amount is fixed, but interest on future advances may be charged at the market rate. Construction loan. So technically, there's actually 2 closings when it comes to construction loan, right? First, you have the closing where you can basically get kind of approved for the loan that you can start the construction. And then once you, sometimes you'll hire a general contractor. Sometimes, the bank will usually want you to do that. And they'll say, okay, here we are. First, we do the excavation. So the guy or the woman comes out and cuts down a bunch of trees. Now that person wants to get paid. So what happens is there's all these, basically these provisions that allow for draws or payments to the general contractor or the person that did the work. So now the inspector for the bank that you basically pay for comes out and looks and says, yes, everything's been done, it looks fine. And so now they do a draw to pay the excavator and whoever dug the big hole. For the concrete person, now the concrete person comes out, pours the concrete, the consultant or whatever it is that you use that the lender has agreed upon and is also kind of representing the situation, comes out and looks and says, yes, the concrete is poured. Maybe you have to get the building inspector for the town to approve it as well. And then it's done, and then a draw is taking place. So you see, you keep building up the balance, because then you pay the framer and the roofer and the electrician and the plumber and the sheetrocker, and the story goes on, and there's all these different draws, and the lender has to inspect the work every step of the way. And you're only usually paying the interest on the money so far that has been borrowed. And then at the end, there's usually arrangements for the permanent loan. And that's the end loan or takeout loan, right? Where the construction financing lender is basically done and they want to be paid off. And then you get the final loan of what you're going to be paying for that work that was done. I did it a long time ago. It's actually pretty cool, a lot of fun, but it's also a lot of stress because, you know, construction is not easy, especially when you're getting a lot of different parties together. Anyone have any questions about construction loan? How about sale and lease back? What's sale and lease back all about?
When someone sells it and then rents it back.
So you might be one of those people that you need money to buy all this new equipment so you can build the nicest and best furniture for your factory. But you don't have the money for it. But maybe you have this big factory and all this land that's, you know, this factory is 50 years old and the land, and it's worth a lot of money. Well, you might be able to sell it and then make arrangements to lease back so that you can free up the capital, get that money, buy new equipment, and be able to keep your business running and use it as working capital, right? How about a buy down? Buy down is usually when we're talking about a home builder that wants to offset or give the buyer a break, you know, help the buyer be able to afford or give them, you know, an incentive to buy, but not go down on the sales price of the house. You see, because if they're a builder and maybe they have 40 houses, you're maybe only the second one who's buying a house in that development. Well, if you buy the house at this price, then everybody else is going to expect to buy at this price. So the builder would rather keep the house at this price, but then give you other incentives like maybe an interest rate buy down. Make sense? Home equity loan is pretty simple, can be used for a lot of different reasons. Financing an expensive item, installment loan, paying medical, education, home improvement expenses. Just be careful. Don't use it to go buy a Cadillac or a big SUV or a boat or a camper, because you remember, you're putting your personal home at risk. Some financial analysts might tell you it's a good idea, but if you're not a really, really disciplined person, don't leverage your home to the max that you live in, because you never know when emergencies coming into play, right? There's all these different federal financing legislation. We have the Truth in Lending Act, TILA, right? And that was basically, they enacted a law called Regulation Z, right? Applies when a credit transaction is secured by a residence. This is for lenders that they have to inform you of your annual percentage rate, what the service charges are, if there's any additional loan fees, they have to tell you this, right? And so remember, a creditor or a lender is the one who has to deal with Regulation Z. And one of the things that they tell you in your book is there's such a thing as called a 3-day or a 3 business day right of rescission. So if you buy a house, today's August 21st. Wow. Today's August 21st. If you buy a house today and have the closing, do you have 3 days to change your mind? How about if you sign a purchase and sale agreement for a house? Do you have 3 days to change your mind? Anyone? You don't want me to take out this shirt, do you? I came, I saw, I sold. You guys want me to get serious business over here, huh? Who believes that? Yes or no? Is there anyone
Yes.
out there?
Yes.
You like a yes? Anybody else?
Yeah, you can always change your mind, but are you obligated?
Do you get your money back? Can you
No.
cancel it with no repercussions? Our society is used to saying yes, but the answer when it comes to owner-occupied homes, first mortgages, is no. So remember that. Now you might be like, Rob, that's not true. Because when I did a refinance of my house, they said I could change my mind in 3 days. Yes, you can change your mind and cancel it for refinancing. But remember, when you have a closing of a house, you can't go move into the house for 2-3 days and be like, you know what? I don't really like this house. I changed my mind about it. Okay, you can't do that. Can you do it maybe for some car loans or camper or motorcycle or refinancing of your house? Probably yes. But when it comes, and they put this in italics, this right of rescission does not apply to owner-occupied, residential, purchase money, or first mortgage, or deed of trust loans. Okay, so please remember that. Regulation Z also talks about financing advertising, that if certain trigger terms are used, like if they say a certain, when it comes to real estate, a cash price, required down payment, number and amounts of due and all payments, if they're telling you, hey, buy this house, we'll give you the loan for only $1,295 a month. Can they do that? Yes. But if they do it, they have to provide all the other information in the same advertisement. Otherwise, they can get in trouble. They can't just like use these triggered terms and get you tempted and not give you the full story in the same advertisement. Otherwise, there can be a lot of penalties. They may be liable for twice the amount of the finance charge at a minimum of $400 and maximum of $4,000. There could be a class action lawsuit. They could make them responsible for all types of fees and court costs. And in addition, a willful violation is a misdemeanor punishable by up to $5,000 or 1 year in prison or both. All right. We also have the Equal Credit Opportunity Act prohibiting discrimination in the lending process. So remember, there can never be discrimination in granting credit based on race, color, religion, national origin, sex, marital status, age, and receipt of public assistance. Can they tell you you can't get this loan because you have a low credit? Yes. Can they tell you don't make enough money? Yes. Can they tell you you have too much debt? Yes. But with the Equal Credit Opportunity Act, this is what's prohibited. And so you as a real estate agent, this is not part necessarily for you, but it's for you to be aware of things and making sure that your client is being treated fairly and that they're getting the service that they should from their lender. Otherwise, give them advice to go somewhere else because you want your client to be treated like gold, right? And so that's really important. We also have the Community Reinvestment Act of 1977. And what it basically says, right, is again, this is a mortgage financial institution act that to meet communities' needs for low income and moderate income housing. What it's basically saying is that if someone, a federal institution, federal related financial institution, or federally regulated financial institution, let's pretty much just say a bank, right? But it could be other things too, bank, credit union type of thing. if they are taking deposits in a certain area, they also have to give out loans in that area. You know, it's not like Bank of boom, 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 boom can open up a branch in a low income area with a lot of crime and open up checking accounts and savings accounts, but then not give out loans. You see, that would be a big problem, and that would be in violation of this. So that make sure that all communities have equal rights to get financing opportunities. Make sense to everyone? Who has questions on that? Okay. We have what's called Respa, the Real Estate Settlement Procedures Act, which we go over a little bit more in another unit, but basically applies to all real estate transactions involving a new first mortgage loan, right? And so they're going to want to make sure, again, that all costs are disclosed in the transaction, that you get closing disclosures, you get a loan estimate in the beginning of the process within 3 days, so that you can make a decision if you want the loan. And then before the closing, 3 days before the closing, you get your loan estimates, your closing documents, so that you can review the numbers and know what you're signing up for. So that's going to be important to know. And then lastly, we have what's called automated underwriting and scoring. When it comes to Freddie Mac, they have a system called Loan Prospector. When it comes to Fannie Mae, they have a system called Desktop Underwriting. And I used that years ago. It's really pretty cool. Basically what it does is that I can take your mortgage application once, run your credit once, and then once I press the button, I can put it out there depending on who you go to for a broker or a lender, but I can put it out to all the different investors or lenders or banks that are interested in your loan and giving you money, and they will spit back to me what it is that they're willing to do. Maybe one is saying, well, we'll give you this interest rate, and they will cost you this amount of points, and we'll do this and this and this down payment and so forth. And then I'm able to come back to you as a consumer and say, hey, listen, here's the couple of different loan opportunities I have for you. What do you think? What is it that you're looking to do? So that is basically this unit 13. What kind of questions do you have on it? Anyone have any questions about everything we kind of went over? All right, so what we're going to do is get prepared for the quiz. Woo! Everyone excited? All right, take out a piece of paper and a pencil. Let's get rolling. Just give me a minute. Okay, let's go over the quiz together, my friends. So, number one, all of these are rules of the Federal Reserve System except, what do you like? Help counteract inflationary trends, create favorable economic climate, maintain sound conditions, or make direct loans to buyers.
D?
That's right. They do not make direct loans to buyers. That's up to the lenders, right? Number two, a lender who collects payments, processes them, and follows up on loan delinquencies is said to what? What do they mainly do? B. Yeah,
B?
they service the loan. Okay. Number three, the primary mortgage market lenders that have most recently branched out into making mortgage loans are who? Who's the latest ones that have actually are making the mortgage loans?
Okay.
Yeah, I mean, we might not realize it, but it's kind of a new thing for, I guess, according to the book anyways. It's kind of a little bit of a new thing for credit unions to do it, because they were kind of known for short-term consumer loans, but now they're doing mortgage loans too. And usually, a lot of times they'll give you some great rates. Number four, the FDIC does which of the following? So remember, FDIC, the brown little sign with the gold lettering. What do they do?
C.
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 C. Oh,
Remember, FDIC, 250 grand. Okay, so they're the ones who are going to insure the deposits for people, the FDIC. Number 5, one way a borrower can obtain a conventional mortgage loan with a lower down payment than 20% of the purchase price is by what?
C.
You got it. The wonderful world of PMI. All right. Number 6, a package loan includes what?
A.
A package, right? Real and personal. Number 7, to qualify for most conventional loans, the borrower's monthly housing expenses and total other monthly obligations cannot exceed what percent of the total gross monthly income?
B.
You got it. If you answered this one, that means you even did great on the last unit, because this was in the last unit. So remember, 36%, right, is housing expenses and other. Remember, 28% would be just monthly housing. So the answer for 7 is B. Great job. Number 8, what does private mortgage insurance cover? Does it pay the lender if the borrower dies? No.
No.
Does it reimburse the cosigner if the borrower defaults? No.
No.
What does it do? It protects the top
See.
20 to 30% of the loan against borrower default. Right? So the PMI is for who? For
The lender.
you? No, right? It's for the lender. Number 9, Regulation Z applies to what? Residential loans.
A.
Not business, not commercial, not agricultural. Number 10, who is responsible for paying the broker or the broker's salesperson when one of them uses the CLO, computerized loan origination system, to take the loan application from a borrower? So who usually pays for closing costs when they're buying a house?
Seller.
B.
C.
B.
Just remember, the buyer's got to usually pay for their own closing costs. Sometimes they think they're doing something smart by saying, oh, and I want the seller to pay for my closing costs. Well, the seller's looking to get a certain amount of money. If you're asking the seller to pay for closing costs, then that's going to be added on top of the purchase price, which means that you're pretty much just paying for that over 30 years. You're pretty much just raising your payment for 30 years. Number 11, a wraparound loan enables a borrower to what? What does it enable the borrower to do?
Penalties. B.
A.
A, right? So they have basically, without an existing mortgage loan, to obtain additional financing from a second lender without paying off the first. I mean, basically, the second lender is giving the borrower a new increased loan at a higher rate. So think about a wraparound loan this way. You own a particular property, you own a 5-family, and now next door you want to buy the 8-family. But maybe on your credit report and so forth, there's just too many properties that you already own. So the mortgage person says, hey, we can give you this second loan, but we need you to pay us for the first loan and the second loan. And then we, as the second lender, are going to pay off the existing loan every month. Does that make sense to you? Anyone have any questions on that? So with existing mortgage loan to obtain financing from a second lender without paying off the first loan. Because otherwise they wouldn't give you the money to borrow the 8-family if they weren't able to control the situation. That's what it basically comes down to.
With a wraparound loan, Rob, is that with the same lender providing a mortgage for Both properties?
It doesn't have to be. No, it could be like a different lender.
Okay.
Yep, it could be a different lender. Number 12, all of these are lenders in the primary mortgage market except.
C.
Well, here's
A.
here's the trick on the words, right? Are endowment funds lenders? Yes, right? Do they give the money? Insurance companies? Yes. Credit unions? Yes. But mortgage brokers are technically, this is a terrible question. I'll agree with you. But technically, they are intermediaries is what your book wants you to know. Remember, they bring the parties together. Sometimes there's in-house lending, but most of the time, no. So 12 is B as in boy. 13, we had a problem with the question, so we took that off. What happened to the screen here? I don't know. Does everyone see the red lines?
Yeah.
Yes.
I don't know why that came up. 14, a house at a price of $240,000. The buyer obtained the loan for $220,000. If the lender charges 3 points, how much will the buyer pay in points? How would we figure that out? Take this 220,000. If somebody can mute themselves, who is ever talking in the back, I appreciate it. So we have this 220,000 and we multiply it by what?
0.03.
3%.
0.03 or 3%, which equals what?
B.
Boy,
B.
you got it. Number 15, on which type of loan can the borrower prepay without penalty?
D.
Anybody else?
B.
I can't see the rest of the answers. Oh, D.
You got it. Good job, all of you. All of these. So remember, in most residential loans that I know of today, there is no prepayment penalty. There is still some in some commercial, but in residential, I don't know of any. Number 16, the Equal Credit Opportunity Act prohibits discrimination in the lending process based on what?
D.
D.
E, all of these, race, religion, marital status, and there's more. Number 17, a woman bought a home. The asking price for the home was $585,000. The woman offered $565,000 and the seller accepted. The appraised value of the home is $560,000. The woman plans to pay $94,600 in cash and take out a mortgage for the remainder. What is the loan to value? So how much is the loan to value? How much did they put down? How would we figure that out?
94.6.
Yeah.
So
So think about
560 divided by,
what's lower, the purchase price or the appraised value?
Appraised value.
Right? That's first off to think about. And then second of all, how much did they buy it for? $565,000. So what you have to do is you have $565,000, right? Minus the $94,600. Okay. Equals how much? $470,400. And then from there, you're going to divide. That's where the hard part is for some of you, might be, because it's even hard for me to think about it. You have to take, okay, here's the amount remaining, right? And you're going to have to divide by whatever is lowest, which is $560,000. And that's how much is the loan to value, which equates to what?
C.
You got it. It's just one of those things to try to figure out in your mind. All right. A buyer is purchasing property from a seller. The seller bought the property on December 20th, 1999 with an FHA loan and has lived there ever since. Because of its favorable terms, the buyer would like to assume the mortgage. Is it possible? And they will say yes, but the buyer has to undergo complete qualifications because the loan was made after December 15th, 1989. Assumptions are not permitted without complete qualifications. So remember that date, December 15th, 1989. Number 19, in 1967, a man served for 6 months on active duty in Vietnam. In 1998, he was killed in a skiing accident. His widow wishes to use the man's life insurance money to make a down payment on a condo and believes she is entitled to a VA guaranteed loan. Is she correct? So what do you think? Can she do it?
Yes.
So here's the problem. It was in a
No.
skiing accident. So the point is, the answer that they want you to know, which to me is terrible, but what can I say, is no, because the man's death was not service related. If it was service related, she would be entitled. But because it's not, she's not. Make sense to everyone? 20, which of these makes direct loans to qualified buyers?
A.
Does the VA make direct loans? No, they're guaranteed, but they're not direct. Does Fannie Mae make direct loans?
Oh, if it,
Yes.
No, they do. They do secondary mortgage market stuff. Does the FHA make direct loans?
No.
No.
They insure the loans. So what is FSA? Farm Service Agency.
oh, yeah.
And they do make direct loans. I know a lot to absorb, but you're doing great. It takes a lot, you know. All right, we only got 6 or 7 more, maybe 8 more to go. A woman is purchasing a fully furnished condo unit. In this situation, the woman would be most likely to use a what?
A.
Package.
A.
Package loan is personal property and real property. 22, a real estate broker has a CLO terminal in her office. Because there are more than a dozen lending institutions in the city, the broker has found that the CLO greatly streamlines the application process for her clients. She sits down at the terminal with a home buyer, and these 3 events take place. She explains that there is a fee for using the terminal of 1/2 point based upon the loan amount, and that the home buyer may choose to finance the fee. The broker also explains the only different kinds of services by the 2 lenders who pay her a monthly screen fee to be included, and the broker helps the homeowner answer the on-screen qualification questions. So which of these events is an improper use of a CLO? So the answer that they want you to know is B, because what does number 2 do? It limits the disclosure about the availability to other lenders, right? They have to be known that there's other lenders, but you see, it explains only the different kinds of services offered by the 2 local lenders who pay her a monthly screen. It doesn't tell her, what about all the other lenders? You see? So that's the problem with 22. That's why they're saying that that's improper. Does that make sense to everyone?
But the broker can help answer the questions.
Well, they're explaining only the different kinds of services by only 2 local lenders. See, that's the issue. But yeah, can they explain that there's a fee? Well, remember, we're talking about mortgage broker, right? and real estate broker, because there's some real estate brokers that they can do this type of thing. You know, they can offer even second mortgages and so forth. But the whole point is they can explain different fees and so forth if they're involved in that mortgage process. But they have to be full disclosure on other lenders too, not just limiting the consumer. That's what they really want you to know. Does that make sense to everyone? All right. 23, the Equal Credit Opportunity Act prohibits lenders from discriminating against credit applications on the basis of these factors, except. What do you like?
B.
B.
You got it. Past credit history. Can they prohibit upon religion? No. Income from public assistance? No. Marital status? No. But past credit history? Yes. 24, lenders that make conventional loans to sell in the secondary mortgage market follow the standardized forms and guidelines used by Fannie Mae and who?
D.
You got it. Freddie Mac. Which of these may lawfully be used as part of a loan application evaluation process?
C.
You got it. They can't. Can they use religious beliefs? No. Age discrimination? No. None of these? No. It's credit score. So that can be used as part of the evaluation process. 2 more to go. The real estate financing market is comprised of what?
C.
You got it. Primary, secondary, and government influences. And 27 and 28, we'll wrap it up for the day. A 16-year-old female applied for a conventional loan in order to purchase a condo. The lender denied the application, citing the applicant's age as the reason for the denial. Which of these is true? The lender violated the ECOA because the applicant is female and sex cannot be considered, cannot be a lending consideration. That's not true.
C. Underage, right?
That's right. C, they denied it because the applicant was under 18 and too young to sign a contract. And 28, what helps lenders reduce the risk on a conventional mortgage loan with a high LTV?
A.
You got it. PMI. So helps them to reduce the. All right. So that, my friends, is the unit on government involvement in real estate financing. Hopefully you found it a lot